Welcome to Y News, I am Christopher. The U.S. Treasury Department released its international capital flows report on Monday. Foreign purchases of U.S. Treasuries rose to the highest level in 2 years in March, with overseas debtors, China and Japan both increasing their holdings, as investors snapped up government bonds with safe haven features in the U.S. banking crisis in March. Foreign holdings of U.S. Treasuries rose to $7.573 trillion in March, up about $230 billion from the previous month's $7.343 trillion. Gennady Goldberg, senior interest rate strategist at TD Securities in New York, said the monthly increase in U.S. Treasuries in March was the largest since June 2021. This month is particularly important because it's a period of volatility in the banking sector. What is most interesting is the absolute amount of U.S. Treasuries purchased, Goldberg said. Investors were reducing risk at the time due to banking sector stress. China was buying a lot, Japan was buying a lot. Purchases by or through the UK are also interesting, which suggests that hedge funds are buying U.S. debt, he added. China ended a 7-month streak of record low positions since 2010 in March. Japanese positions rebounded after a pullback in February and did not continue near more than 3-year lows. However, overseas holdings of gold are increasing more rapidly. Global central bank gold purchases in the first quarter hit a record high for the same period, and Chinese gold reserves rose for 5 months in a row as of March. Official U.S. data show that in the Silicon Valley Bank collapse triggered the banking crisis, prompting the market to the Fed to raise interest rates is expected to quickly cool in March this year. The two major U.S. overseas debtors, China and Japan, both increased their holdings of U.S. debt. On Monday, May 15, EST, the U.S. Treasury Department released its International Capital Flows Report, showing that the country holding the most U.S. Treasuries in March was still Japan, with mainland China still in second place. Japan's holdings of U.S. Treasuries increased by $5.9 billion in March from February to $1.1 trillion, after falling in February from a 4-month high set in January and not continuing to approach the 3-year low set in October last year. Japan's position in U.S. debt hit a 3-month low for the third consecutive month since at least December 2019 from August to October last year. The size of mainland China's holdings of U.S. Treasuries rose $20.5 billion to $869.3 billion in March from February, the first year-over-year increase in the position in the 8 months through March. As of February, China had reduced its holdings of U.S. debt for 7 consecutive months, with its total position hitting a 7th consecutive monthly low since May 2010. China's position in U.S. debt has been below $1 trillion since last April. The TIC report also showed that net inflows of overseas funds attracted to U.S. assets totaled $56.7 billion in March. Among them, net inflows from overseas private investors were $13.2 billion, and net inflows from overseas official funds such as central banks and sovereign wealth funds were $43.6 billion. The size of net overseas inflows into long-term U.S. securities was higher, at $110.5 billion. This included U.S. stocks purchased by overseas portfolios through equity swaps, and after some adjustment, overall net overseas purchases of U.S. long-term securities in March were $133.3 billion. The yield on the benchmark 10-year U.S. Treasury note fell about 45 basis points cumulatively in March, resulting in a cumulative drop of about 40 basis points in the quarter, falling back after 6 consecutive quarters of gains. Although the TIC report shows that in March, China and Japan, two major debt owners, rare collective increase in U.S. debt holdings, but in recent years, the increasing global de-dollarization, as well as central banks and other overseas official institutions to take the initiative to actively diversify their positions, will not change the trend. China's State Administration of Foreign Exchange announced last month that China's foreign exchange reserves rose by $50.72 billion to $3.18387 trillion in March, up $50.72 billion from the end of February, a 1.62% increase from the previous month. Gold reserves rose by 66.5 million ounces in March, up 580,000 ounces from the end of February, a 0.88% increase from the previous month, the 5th consecutive month. Although the two major U.S. debtors in March rare increase in holdings of U.S. debt, reversing the trend of the past few months, but there is no doubt that in recent years, the global de-dollarization tide is intensifying. The central banks of some countries and other official institutions are actively seeking to diversify their positions. For example, they are actively buying gold. According to the Global Gold Demand Trends Report released by the World Gold Council earlier this month, in the first quarter of this year, global central bank gold purchases got off to a strong start, with central banks and other institutions buying 228 tons of gold, up 176% year-on-year, the highest year-on-year gold purchases since 2010. Previous analysis by the Tianfeng macro team pointed out that the widening scissors between foreign exchange reserves and gold reserve changes reflects that central banks are beginning to distrust the existing international settlement currency system represented by the US dollar. Tianfeng believes that the monetary properties of commodities are rising under the continuous supply shock. In turn, gold is the commodity with the most monetary attributes, which is the premium given to gold by the national transportation cycle. J.P. Morgan Chase in a report published on May 12, has no risk of default, and for the U.S. Treasury counterparty gold's attractiveness is expected to soar, which in the global central bank efforts to de-dollarization is reversing the dollar supremacy and is accelerating the trend of liquidating U.S. debt for gold, and the field of foreign reserves will become more clear. And the core logic behind this is actually quite simple. Because, according to the U.S. Treasury Secretary's explanation, is that once the U.S. defaults, it will stimulate interest rates to soar and will bring a disastrous situation to the U.S. economy and finance, thus triggering U.S. asset prices and the U.S. debt market, which in turn will drive the reversal of the gold price. Another reason is that the fact that the deposit outflow from the big U.S. banks has accelerated since the last 2 weeks also shows that, despite the very great efforts made by the Treasury and the Federal Reserve, but the U.S. banking crisis is not over. In particular, the market is now suspecting that once the U.S. banking crisis gets out of hand and the first default in history occurs, the U.S. Treasury may also follow the Swiss Treasury's lead and provide the excuse for the U.S. to directly default on some of its foreign debt to follow the trend, and the latest news is feeding back into this analysis in a big way.